Welcome back to this channel. If you're curious about how artificial intelligence is reshaping the finance industry, you're in the right place. We'll explore real-world case studies and see how businesses leverage predictive analytics to make smarter financial decisions with AI. What will you learn in this video? Starting with what is predictive analysis, then discuss how AI enhances predictive analytics with case studies of J.P. Morgan and Fintech startups. Also discuss the benefits of predictive analytics in finance and end up with the conclusion. Furthermore, don't forget to answer in the comment box of multiple choice question end of each topic covered. Let's start with the interview question might ask, like, what is predictive analytics? Well, you can answer this way. Predictive analytics uses historical data and statistical algorithms to forecast future events. What does it mean in finance? This means analyzing past market trends to predict future movements. This technology helps businesses understand potential risks and opportunities, allowing them to make informed decisions. For example, companies can predict market fluctuations or customer behaviors, giving them a competitive edge. Now hold for a minute here and answer this question. What is predictive analytics primarily used for in fintech companies? Option A, to create new financial products. Option B, to analyze past data to forecast future outcomes. Option C, to manage customer service inquiries. And Option D, to conduct in-person financial consultations. Type your answer in the comment box. Now, we move further and discuss how AI enhances predictive analytics. Well, artificial intelligence, especially through machine learning, enhances predictive analytics by analyzing vast amounts of data quickly and accurately. AI algorithms learn from data patterns, improving their predictions over time. This capability is crucial for financial institutions that need to stay ahead in a fast-paced market. Let me share a study by McKinsey found that companies using AI for financial forecasting can reduce errors by 30 to 50%, leading to more precise decision-making. Let's look at a real-world example. J.P. Morgan, one of the largest banks globally, uses predictive analytics to assess potential impacts on the market by analyzing global news. Their predictive algorithms evaluate how news events might affect stock prices, allowing traders to make informed decisions before market shifts occur. Imagine a headline says a company has just launched an exciting new product. J.P. Morgan's system would analyze similar launches in the past. If those launches usually led to higher stock prices, the system might suggest that traders should buy shares of that company before prices rise. Let me share another case study, how fintech startups are utilizing predictive analytics. Many fintech companies offer personalized financial advice by analyzing clients' historical data and financial goals. How fintech startups use it? Well, first, by personalized financial advice. It means fintech companies analyze information about their clients, such as how much money they earn, how they spend it, and what their financial goals are. This helps them create advice that is tailored specifically for each person. Next, by predicting credit risk. For example, if a customer wants to borrow money, the fintech company can look at their past spending and payment history to see how likely they are to pay back the loan. This is called predicting credit risk. If someone has a good history of paying bills on time, they might be seen as a lower risk for borrowing money. Third, by tailored investment strategies. It means fintech companies can also suggest investment strategies based on how a person spends their money. If someone tends to save a lot and has specific financial goals, the company can recommend investments that align with those goals, helping them grow their savings more effectively. Now hold for a minute here and answer this question. How do fintech startups personalize financial advice for their clients? Option A, by using a one-size-fits-all approach. Option B, by analyzing clients' historical data and financial goals. Option C, by offering the same advice to all customers. Option D, by relying solely on market trends. Type your answer in the comment box. So, why is predictive analytics so vital in finance? Well, here are some key benefits. First one, improved risk management. It means by identifying potential risks early, businesses can take proactive measures. Next, enhanced decision-making. It means data-driven insights allow for quicker and more accurate decisions. And the last one, increased efficiency. Means automating data analysis reduces manual workloads and saves time. These advantages make predictive analytics an essential tool for financial institutions aiming to thrive in today's data-driven world. Now hold for a minute here and answer this question. What does predicting credit risk involve? Option A, guessing whether a customer will pay back a loan. Option B, analyzing a customer's past spending and payment history. Option C, looking at current market conditions only. Option D, offering loans to everyone regardless of history. Type your answer in the comment box. In conclusion, predictive analytics powered by AI is transforming financial decision-making. With real-world examples from JP Morgan and Fintech startups, it's clear that leveraging these technologies leads to smarter strategies and improved outcomes. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights into the world of finance and technology.